You know, when you're just walking down the hallway of like any standard office building, there's always that little red metal box on the wall.
Oh, right, with the glass front.
Yeah, the fire
The
extinguisher.
whole classic, break in case of emergency setup. You probably walk past it 1,000 times and just you hope you never actually have to touch the thing.
Exactly. I mean, you pay for it, you install it on the wall, and your absolute biggest hope in the world is that you get to completely ignore it forever.
Right.
Because if you were interacting with it, well, something has gone terribly, terribly wrong.
Yeah, it's really the ultimate defensive purchase.
It is. And for, I'd say, the vast majority of people, that is exactly how we view insurance. It's a financial fire extinguisher sitting in a metaphorical glass case.
Yeah.
You know, you pay your premium, you get your policy documents, you file them away in some like digital folder somewhere, and you just pray you never have to look at them again.
You really do.
But, and this is the big question for today, what if treating insurance like a glass case on the wall is exactly why most businesses completely fail when a crisis actually hits?
That right there, that's the core argument in our source material today.
Yeah.
We're doing a deep dive into a really brief, but honestly incredibly potent excerpt from a document that's just simply titled Property Restoration.
Which I know sounds a bit dry at first glance.
It does, but it completely flips the script on how we treat this traditionally mundane subject. It's taking a defensive expense and basically turning it into an offensive growth engine.
Okay, let's unpack this. Because the text, it starts by identifying this fundamental misunderstanding right out of the gate. And it's really all about the timeline, like the timeline of how we engage with insurance in the first place.
Yeah, so the opening lines, they state, most people think insurance is something you buy once a year.
Yeah.
We think differently.
Yeah.
And what's fascinating here is just the psychology behind that once-a-year mindset.
Yeah, what do you mean?
Well, we treat it kind of like renewing our vehicle registration, right?
Oh, sure.
You do the paperwork, you pay the fee, they send you your little sticker, you put it on the license plate, and you just forget about it for 12 entire months.
But how can a static document, which is essentially just a contract, be dynamic? I mean, to me, treating insurance as this once-a-year purchase, it's like buying a gym membership in January, right?
Oh, I love this analogy.
You buy it on January 1st, you get your little plastic scan tag for your keychain, and then you literally never speak to a trainer, you never adjust your diet, you never even go to the gym, and then you magically expect to be in peak physical condition by December 31st.
Right. The signature on the contract doesn't actually lift the weights for you.
Exactly. An annual signature can't possibly drive daily business strategy.
And yet that is exactly how most businesses treat their risk management. I mean, they lock it in on January 1st and they just walk away.
Which is why.
It is. Because the danger there is that a business is a living, breathing entity. Month to month, things evolve.
Yeah, you take on new clients.
You take on new clients, you buy expensive new equipment, maybe you hire untrained staff, or you enter completely new regulatory environments.
So by July, the actual physical business that you're operating out there in the real world might look completely different than the theoretical business that's described on that piece of paper.
Exactly. Which creates a massive, massive blind spot.
Wow. Yeah, I can see that.
If your engagement with your safety net basically begins and ends at that annual renewal, you aren't actually managing risk at all.
Right. You're just blindly funding a piece of paper.
Yeah, without ever checking if it even covers the specific tightrope you are currently walking on, especially in a field like property restoration.
Where things are intense.
Right, where you are dealing with catastrophic damage, highly unpredictable variables, massive liabilities, literally on a daily basis.
It's kind of the difference between, like, buying a paper map once and plotting a route versus using a GPS on your phone that recalculates based on, like, real-time traffic and accidents and new roads as you're actually driving.
That is a perfect way to put it.
So because that once-a-year mindset is fundamentally flawed, the text then kind of provides this entirely new blueprint for what the strategy should actually accomplish.
Right. It leads directly into the core promises of the document.
Yeah, it lays out these 5 central directives, or pillars, really. And it says, a good insurance strategy should help you win contracts, support growth, reduce claims, protect cash flow, and strengthen your business. And I really want to dig into the mechanics of these because that first claim,
The big one.
it's a massive curveball. A good insurance strategy should help you win contracts. Wait, how does insurance help you win contracts? Because, I mean, marketing and sales win contracts, right? I pitch you on my services, I give you a great price, I show you my portfolio. The insurance is just the boring administrative paperwork we do after we've already signed the deal.
If we connect this to the bigger picture, you have to look at how businesses evaluate trust. What you just described, that's the very traditional view.
Okay.
But put yourself in the shoes of a massive commercial property manager for a second.
All right, I'm a property manager.
Right. And you have just suffered a catastrophic flood in a 50-story high-rise.
Oh, wow. Okay.
Yeah, water is actively destroying millions of dollars of infrastructure. You need to hire a restoration company right now, today.
Stressful day at the office.
Extremely.
Right.
And you have two bids on your desk. Company A has a really slick sales deck, a decent price, and the bare minimum legally required insurance coverage.
Got it.
Then Company B comes in. And Company B says, hey, here is our comprehensive, custom-built risk management portfolio. We are indemnifying you against secondary water damage, against chemical exposure during the cleanup, against structural failure. If anything goes wrong on our watch, you, the property manager, are completely insulated.
Oh.
Who are you hiring?
Okay, that makes total sense, because if the stakes are high enough, the risk mitigation is actually part of the product I'm buying from them.
Exactly. It's like a field acting as a sword.
Right. It's not just defensive armor that you hope you never use. It's an offensive tool. Company B is signaling stability.
Yes.
They're proving they have the actual financial backing to handle the worst-case scenarios without dragging my building into some messy multi-year lawsuit.
In B2B environments, especially when you're dealing with things like structural integrity or human safety, proving you're a highly sophisticated operation, that is a massive trust signal.
That competitive edge is how a robust policy helps you go on the offense and close a deal over a competitor who's just, scraping by on minimum coverage.
Precisely. But of course, if robust insurance wins you a massive contract, like that high-rise,
Suddenly you have a totally new problem.
right, you have to actually fulfill the contract.
You might have to scale up your operations overnight just to handle a job that big. And that introduces a terrifying amount of new risk, which naturally brings us to the second pillar, supporting growth.
Because growth inherently requires risk.
Yeah.
You are stepping into the unknown,
Yeah.
taking on a project twice the size of anything you've ever done before. That might mean leasing a fleet of new trucks, hiring 40 temporary workers who really don't know your safety culture at all, dealing with totally new hazardous materials.
And all of that unknown just paralyzes a lot of business owners.
Totally. And if you have a weak, generic insurance policy, that fear literally dictates your ceiling.
How so?
Well, you might look at that massive high-rise contract and decline it, purely because you are terrified of the liability if just one of those new temporary workers makes a mistake.
Right. You just walk away from the money.
Yeah. But if you have a strategic living insurance plan, one that has been tailored year-round to your specific expansion goals, you can take those calculated risks with confidence.
I love this. It's the safety net that allows the acrobat to try a triple backflip instead of just sticking to a safe double.
Exactly.
The safety net doesn't just catch you when you fall, it actually empowers you to take the risk in the first place.
It supports the growth instead of limiting it.
But, let's be real, doing triple backflips increases the chance of falling.
It does.
If we're scaling fast and taking on massive new jobs, accidents are just bound to happen.
Which brings us to the third pillar in the text, reducing claims.
Right.
Now, wait a minute. Why is the insurance company telling me how to run my business to reduce claims? Shouldn't they just, step back, collect their premium, and pay out when I mess up?
So notice the text deliberately says reduce claims, right? It doesn't say pay claims.
Right, those are different things. Very different. Paying a claim is entirely reactive. It means the damage is already done, the project timeline is completely blown, maybe someone got hurt, and the client is furious.
Yeah, bad news all around.
But reducing a claim is proactive. And it involves this really fascinating mechanism called risk engineering.
Risk engineering? Wait, like structural engineering?
It's a similar concept, yeah.
Yeah.
But applied to operational behavior instead of steel and concrete.
Okay, explain that.
When you partner strategically with a good insurance provider, their actuaries and their safety experts actually analyze your daily operations because they have access to these massive macro-level data sets across thousands of businesses that are just like yours.
Oh, so they see the big picture.
Exactly. So they might look at your job sites and say, hey, we notice your crews are using this specific type of chemical solvent in unventilated basements.
Mm-hmm.
Statistically, across the entire industry, that leads to a 40% higher rate of respiratory claims and long-term litigation. So let's engineer a new ventilation protocol right now before anything happens.
Oh, wow. So they are actively spotting operational bottlenecks like invisible dangers that I, as the business owner, am totally blind to simply because they have the data and I don't.
Right. They are literally engineering the danger out of your operations
Yeah.
before a claim ever even materializes.
That's amazing.
And they do it because it perfectly aligns both of your incentives. If you don't file a claim, the insurance company doesn't have to pay out. It's mutually beneficial.
And here's the catch. You only get access to that high-level consulting if you treat the insurance as a year-round strategy rather than just some piece of paper sitting in a drawer.
Exactly. You have to be talking to them.
And if you are actively engineering risk out of your system, you naturally protect yourself from what is arguably the ultimate business killer, which is the fourth pillar, protecting cash flow.
Yes. Cash flow.
Because I think people fundamentally misunderstand cash flow, right?
Yeah.
Like, you can be highly profitable on paper, have millions of dollars in pending invoices, and still go completely bankrupt by Friday if your actual cash flow dries up.
Cash flow is the oxygen of a business. It just is. And nothing suffocates a business faster than a massive uncovered loss or, a severely delayed claim.
Yeah, let's look at the mechanics of that, like business interruption.
Okay, yeah. Let's say a critical piece of heavy machinery breaks down on one of your job sites. It causes a massive delay. And maybe it even causes some sort of secondary structural collapse.
Ugh, a total nightmare scenario.
Right. Now, if your policy is just some generic off-the-shelf document that you bought 11 months ago and haven't looked at since, it might not actually cover that specific new machinery or that specific type of secondary damage.
So what happens?
You have to pay to fix the collapse out of pocket. That money comes straight out of your operating capital.
Oh, man.
And
Yeah.
suddenly you can't make payroll next week. The business suffocates.
Or even worse, what if it is covered, but the policy language is so vague that the insurance company disputes it?
Oh, that happens all the time.
Your cash gets tied up in a legal battle for 6 months, while a bunch of lawyers argue over the technical definition of structural collapse.
Right. But the mechanism of a strategic policy, one that's managed year-round, is that it's designed with crystal clear terms, appropriate limits, and a deep understanding of your current operational realities.
So there's no ambiguity.
Exactly. So when the worst does happen, the capital injection from the claim is swift. It bypasses that whole messy dispute phase entirely, keeping your cash flow completely insulated from the shock of the event.
Which perfectly brings everything into really clear focus for the fifth and final pillar, strengthening the business. It's basically a compounding loop, isn't it?
If we connect it all together, yes.
Yeah, like you win bigger contracts because you signal trust. Because you have those bigger contracts, you're able to take calculated risks to grow.
Right.
Because you're growing strategically, you use risk engineering to keep your crews safe. And because you're safe and properly covered, your cash flow never takes a fatal hit.
It is a continuous loop of fortification. The text beautifully demonstrates how a piece of administrative overhead, something most people just consider like, a boring tax on doing business transforms, into the actual structural foundation of the company.
And we have to pause here. Let's look at the reality of actually making this happen. Because a piece of paper and a filing cabinet can't do any of this on its own.
No, it can't.
We need to talk about the human element. The text has a very sharp critique of who is supposed to be managing this.
Right. The broker.
Yeah, it says, if your insurance broker only calls before renewal, they're missing the biggest opportunity to help your company. And it contrasts that with their ideal version. It says, the right partner is involved throughout the year, helping you make smarter business decisions, not just selling policies.
This gets right to the heart of the modern broker's role. It explores the stark difference between being a transactional vendor and being a consultative partner.
Okay, break that down for us.
Well, a transactional vendor treats insurance like a cheap commodity. They show up maybe 30 days before your policy expires. They drop 3 quotes on your desk, ask you to pick the cheapest one, collect their commission, and then they literally vanish for another 11 months.
Is it really realistic, though, to expect your insurance broker to be a year-round business advisor? I mean, a lot of listeners are probably thinking, I just want to pay my premium and get off the phone. I have a business to run.
This raises an important question, yes. But think about it like this.
Actually, it reminds me of, like, a bad wedding DJ.
A wedding DJ.
Okay, go on.
Yeah. Like a transactional broker is like a bad wedding DJ who only shows up to play the one song you specifically requested, collects his check, and leaves while the dance floor is empty.
Oh, right.
Versus a consultative partner who's more like a dedicated event producer.
Yeah.
They're there months in advance, helping you orchestrate the entire evening, reading the room, making sure the caterer and the band are on the same page so the party never stops. That's a great analogy. It requires a mutual perspective shift. And honestly, the incentive to be that event producer is actually massive for both sides.
Why? If I'm paying my broker the exact same commission, whether they act like the bad DJ or the great event producer, where is their incentive to have a monthly strategy meeting with me?
Because for the broker, if they only check in once a year, they face an absolute frantic scramble at renewal time.
Right.
They show up in December and suddenly discover the business has completely changed its operational model. They acquired a new warehouse. They hired 50 new people.
Oh, so they're totally blindsided.
Completely. It is a nightmare to underwrite all of that retroactively. And the broker risks losing the whole account to a competitor who actually understands the new risk profile better.
Ah. So if they act as the event producer, sitting down with you in June to discuss the new warehouse you want to lease in October, they can say, hey, let's look at the fire suppression systems in that building before you sign the lease, because it will dramatically lower your premium.
Yeah, exactly. They embed themselves into the business.
They become indispensable.
But a business owner who views the broker merely as a necessary evil, just to fulfill a legal requirement, they will always get a transactional vendor.
Right, you get what you ask for.
The text is urging business owners to demand a partner, to actively invite them into the strategic planning process way before final decisions are made.
And this redefinition of the broker as a strategic partner, it leads us to the text's final, incredibly powerful thesis statement.
It does.
It's all about who is actually in the driver's seat of the business.
Mm-hmm.
The text concludes with this line, because insurance should support your business strategy, not define it.
That is the crux of this entire deep dive. There is a profound difference between a business being defined by its insurance versus being supported by it.
Yeah.
When a business is defined by its insurance, the tail is basically wagging the dog. The limitations of a cheap, generic policy are dictating what the company can and cannot achieve.
Right. You hear this all the time out there. A business owner says, oh, we can't bid on that big municipal roofing job. Our insurance won't let us.
Yeah.
Or, we can't implement that amazing new drone surveying technology because our underwriter doesn't understand it, so we aren't covered.
And what is that?
Yeah.
That is operating out of fear. The actual boundaries of the company's ambition are being drawn by some risk-averse actuary in a cubicle 3 states away.
Yeah, that's wild when you think about it.
The insurance is defining the limits of your potential. But the text argues for the exact opposite.
Right.
You, the business owner, determine the vision. You decide, hey, I want to expand into emergency hazmat cleanup. That is the strategy. You hand that strategy to your consultative partner and say, build me the framework that makes this possible.
Here's where it gets really interesting, because it perfectly maps to, like, a high-performance race car.
Okay.
Think about a Formula One car. Why do engineers put world-class, state-of-the-art carbon ceramic brakes on a car that's literally designed to go 200 miles per hour?
Well, not to go slow, that's for sure.
Exactly. You don't install amazing brakes so you can drive slowly.
No, you install them so you can push the car to its absolute ragged limits.
Yes, you install them so you can confidently drive incredibly fast, knowing without a doubt that you have the mechanical capability to navigate sharp, ambitious turns without crashing.
Mm-hmm.
The brakes don't define the journey. They don't dictate your top speed. They support your ability to go as fast as humanly possible, safely.
That's exactly it. If you have cheap, standard brakes, you have to drive slowly. Your entire race is defined by your lack of stopping power.
Right.
But a strategic, custom-built safety system
Yeah.
that empowers you to accelerate.
So what does this all mean for you listening right now? I mean, chances are you aren't running a property restoration company.
Probably not.
But the beauty of this deep dive is how universal this philosophy really is. I mean, we've gone on quite a journey today.
We really have.
We took a handful of lines from a niche industry document and completely rewired the concept of insurance.
Moving it from a passive annual chore to an active, year-round growth engine based entirely on strategic partnerships.
Yeah, it all comes back to that fire extinguisher in the hallway we talked about at the start.
Right.
If you leave it in the glass case, it's just a sunk cost. You're just paying for it to sit there.
But if you take it out, if you understand how the chemicals inside work, and you use that deep knowledge to strategically plan exactly where you can safely build the biggest, most ambitious campfire.
You completely change the whole game.
You do. It fundamentally alters how you view risk in business.
Hmm.
You're no longer just avoiding it, you're actively managing it to your advantage.
Which is such a powerful takeaway.
It certainly is. And, I think it leaves us with a really interesting thought to ponder as we wrap up.
Oh, what's that?
Well, if a notoriously dry, defensive expense like insurance can actually be leveraged as a proactive business partner to win contracts and drive growth, what other mundane, overlooked operational expenses in your life or business are secretly disguised opportunities, just waiting for a change in your perspective?